Looking ahead into 2024, the macro environment is telling us that we have things to be concerned about. We don't have a crystal ball, but we do have the yield curve and numerous data points in markets to analyse the picture and make some kind of predictions about what we might expect, acknowledging that we are in an investment cycle. Right now, we're seeing inflation continuing to moderate after vast COVID excess. We're seeing the economy starting to cool, which has been expected for some time. And we're certainly building financial vulnerabilities after enormous rate hikes the world over, which will re-engineer a credit cycle that we haven't seen for a long time, with more rises in delinquencies and those types of things. Because of that inflation that is still, it's dissipated, but there are still embers, it's not easy for central banks to rapidly cut interest rates and provide quantitative easing to stimulate markets again, as they have done in all periods since the GFC. When we look forward, obviously there is a number of scenarios that we're considering. Probably the easiest one is to assume that interest rates have been moved up to higher levels to restrict economic activity, and they might stay on hold for some time.
If interest rates stay on hold for the next 12 months, as a reasonable outcome for the government bond market. We're currently receiving 4.5% to 5% interest rates on 10-year Australian government bonds. That's the highest in many, many years. It's not since the advent of the end of the financial crisis that we've seen interest rates at these levels.
Should the economy slow, well then obviously there could be the potential for rate cuts into next year.
Interest rate cuts are nirvana for bond investments. Not only are you receiving the bond income from your investment point, but you will see a capital increase in the price of your bonds as they cut interest rates. If that happens, as we saw in 2008 and the 2020 COVID crisis, you have significant and powerful returns in your government bond portfolio. Typically, bonds perform very well 1 or 2 out of every 10 years, and as bond investors looking at the fundamentals, we can see that there is a good outcome potentially to be had over 2024 from an investment in bond markets.
In a real crisis, obviously, it'll be government bonds that will primarily lead, while other things might be lagging, if not going sadly backwards. Should we get more exogenous shocks, particularly around energy markets and geopolitics, there is, of course, the probability that we might need further interest rate rises. And this would be very challenging for all asset classes.
If we see a rise in interest rates from here, most of the damage has been done in the bond market. So you are now being paid to hold the product, and it will insulate you against further interest rate rises from here. But given that we've seen 12 or 13 rate rises from this point, most of the damage has already been done and passed through to the bond market. If they raise rates from here, it's not going to be another 13 times, it's going to be 1 or 2 more times, which the market has mostly priced.
Interestingly, looking at the medium to longer term, this restoration of yield, which we really haven't seen since the financial crisis in 2008, is really encouraging for investors to build this bedrock allocation of continuously compounding yield, government guaranteed cash flows at 4.5%, 5% yields in many instruments, sometimes even higher. That is a very attractive choice for those that have made a lot of money in the last cycle of extraordinarily low interest rates, very high asset valuations. Certainly for those that are later in their superannuation journey and more concerned with preserving their nest egg, minimizing sequencing events where they might have significant capital drawdown, then the government bond market is a great starting point, as well as other fixed income products will no doubt be of interest to investors. We're continuing to see very strong demand, unsurprisingly, given this rise in yields and the ability to lock in cash flows for many, many years at these healthy yields, which continuously compound to great outcomes whilst offering portfolio diversification and crisis liquidity.